Ladies and gentlemen, I am pleased to introduce you to Akshaya Gaur, the conference chairman. Akshaya has over 39 years of experience in the banking industry, and he has a track record of leadership in banking technology with a strong acumen in customer, business, and delivery focus. Previously, Akshaya was the CIO for Mashreq Bank in the UAE, and he was also Mashreq's subsidiary Mindscape IT's CEO. He has been on Mashreq's executive leadership board, including being on the board of Mashreq Global Services in India. Akshaya has also been the EVP of technology with Standard Chartered Global Business Services, and he has also been the head of information systems for the Africa region at Standard Chartered Bank. Akshaya Gaur is your conference chairman, and it is my pleasure to have him with us here as the conference chairman of the 6th Africa Bank 4.0 Summit, North Africa. Akshaya, over to you, and you are free to turn on your camera and share your screen for the opening session. Over to you, Akshaya.
Thank you very much, Fad, for that very generous introduction. I will now share my screen with you. Give me a moment, please.
You can see your notes.
Yes, I know. Unfortunately, technology is not quite automatic, but I think we should be okay now.
Now we're perfect. Yeah, go ahead.
Okay, thanks once again, Fad, and thanks everybody for joining this summit. Welcome to Africa Bank Summit 4.0. I really look forward to sharing some insights on North Africa's emerging fintech frontier, and as well as the very well established banking sector. So before we go into the details, there are some key change drivers that are required to create a transformation within the region. Our focus, of course, today will cover the standard definition of North Africa, Sudan, Egypt, Libya, Tunisia, Algeria, Morocco, and the Western Sahara. The good news is that the North African countries are making great progress in their digital journey, and with a special mention to Egypt, Tunisia, Algeria, and Morocco. The pace of this journey obviously varies across these 7 countries, and it is determined by the certain key change drivers which you can see on your screen. But one of the most critical factors, change drivers, is the issue of banking the unbanked. Because if we want to grow the financial infrastructure in the region, one of the key factors is that we need to bring in the unbanked into the banked segment. And that is extremely key. If we look at the population versus the internet users within North Africa, we've got some comparators we've put over there. One is the GCC, the Gulf Cooperative Council, and Sub-Saharan Africa. Now, if you look at the internet usage as a percentage of population, it is about 35%. And that presents quite a key challenge. Having said that, there are other factors as well. When we look at human capital and innovation, I have brought in some data from the World Bank that measures human capital. Human capital is about the skills, the financial skills, the technology skills, the education levels, etc. World Bank measures human capital index as shown by the blue bars in the chart, and a combination of human capital and innovation. Innovation is measured by an index called Global Competitiveness Index, and that is represented by those little yellow squares next to the blue bars. If you look at human capital index, North Africa has a pretty high human capital index, which means high rates of education, technical abilities, skills, banking acumen, all these kind of factors. However, the global competitive index is marginally lower than sub-Saharan Africa, which means innovation has still not reached that point. And why is it so? Because there are other factors which we will be covering as we go along. Now, if you look at these factors related to human capital and innovation, these are reflected in the next table, which is the estimated number of fintechs and general startups in the African continent as a whole. So the North African countries in this represent about 106 plus fintechs and about 1,000 plus startups. It's a great start, but as you can see, if you compare the numbers with Nigeria, South Africa, Ghana, there's a long way to go. Now, when we go further and we look at why is it so in North Africa, despite having a high human capital index, but low innovation, and a key factor is also the availability of capital. North Africa, interestingly, compares very well on venture capital availability. As you can see from the blue bars. But if you look at the orange dots, which represent risk-adjusted capital, that means accounting for risk in the capital, there's a big drop for North Africa. And if you look at the financial penetration, you will notice that the unbanked population, or people who have made or received digital payments or the use of internet is quite low, as is the banking penetration. So it is very important that these two also need to be considered together. And the interesting thing is, over here, you will notice that the demand for payment services is more developed in sub-Saharan Africa than in North Africa. Because the use of the internet for financial services transactions is much lower in North Africa. At the same time, the North African countries appear to benefit from better quality infrastructure and a higher abundance of human capital. So, there are balancing factors. And both regions seem to have a fairly healthy environment when it comes to regulation or the availability of financial resources to push the fintech agenda. Now, within North Africa, if you look at the countries, I mean, clearly Egypt is leading the way. Tunisia is a close second, Morocco is growing, and Algeria is still at a nascent stage. And interestingly, you will see that these are 5 startup logos you can see over there: Payment, FinKeys. So the progress is steady, but there's a long way to go. So let us look at what the opportunities that present themselves to financial institutions and fintechs, and what are the shared opportunities. So I will not actually read out this slide. It's there for you to read. But clearly, in addition to all these opportunities, either individual or shared, fintech actually offers a huge opportunity for the region's banks in terms of financial penetration in less developed countries, because they are more agile, they're more creative, they are able to provide solutions. In fact, the history of the African continent has been a result of the fintechs creating efficient solutions with regards to mobile money, etc., etc. And the other factor to consider is that the most likely benefits that come from fintech are in the area of remittances and payments, in terms of banking penetration and financial inclusion, in terms of cybersecurity and security of transactions, and last but not the least, in terms of governance, risk, and compliance. And for financial institutions, these are potential targets where they might be disrupted. So having seen the opportunities, what are the challenges these organizations face? The challenges in the bank fintech collaboration arise from factors like mismatches of the organization ethos. You know, the organization structures, their processes, etc., etc. The clash between the legacy systems of the banks and the emerging technologies used by fintechs. How do you link them up? Banks and fintechs move at different speeds. Their agility is different. Banks are more risk averse and have established procedures that probably slow them down. Fintechs are nimbler and constantly looking for growth and revenue because they've invested their own money into their projects. So there is a tendency for them to move much faster. The other thing is both measure success differently. In banking, adherence to process takes a big space, whereas in fintechs, the process is not as important as the results. I mean, we all of us who worked in banks will probably know that a successful project or a launch of a product is not considered very good if audit finds that the process followed wasn't exemplary. So we are conditioned to move in a certain way in banks, whereas the startups are not. But thankfully, there is one very big common factor. Both wish to maximize revenue. So what is the way forward? In my view, the only way financial institutions and fintechs can actually work together is through collaboration. So, how does that work? If we look at the history of banks and fintechs, you would all have seen a huge degree of mutual mistrust between the two types of institutions. Uh, Banks looked at fintechs as, you know, here today, gone tomorrow, not really reliable. And fintechs looked at banks as people who would completely exploit them for their own ends. So after a stage of mutual mistrust, and they started looking at each other as competition. And banks, on the other hand, decided that the good thing that fintechs have is innovation. So they started trying to set up their own innovation centers and very quickly realized that the cost of innovation was very high. And this was primarily because banks are so much more focused on running the bank, on following process, on achieving targets, that they have no time to sit back and innovate. And so the cost of innovation is very, very high. Banks are realizing that they were not designed for innovation. They may have had a few bright sparks in the organization, but by and large, they were designed not for innovation, but being stable, steady executors of processes. Also, in terms of organization structures and individual silos, the ability for technology and the business has always been fractious. And so they also realized that since they are so heavily regulated, their ability to take chances with making processes more customer friendly was very difficult. And last but not the least, banking technology is legacy. And the cost of making it compatible for emerging technologies itself was very high. At the same time, fintech was also having this realization that while they have great ideas, they just don't have enough money to translate them into reality. Once they do so, the cost of customer acquisition is just too high. And guess what? They also realize that banks have a large number of customers, and if they partner with them, they could have a huge bank of customers for their creative solutions. So, with these realizations, both financial institutions and fintechs started moving towards a kind of strategy that required them to work together. Interestingly, in fact, three banks in Egypt very recently got together to set up a fintech fund. And clearly, their focus was on innovation, being an investment arm, and also to promote the concepts of open banking within banks. So, what are the key benefits of bank and fintech collaborations? Results are quite obvious for both. There is a mutual building of brands, but more importantly, that is happening through the ability of being able to offer enhanced features and customer experience to their end users, the making it easier for their customers to use banking applications, thus building their consumer base, reducing costs, and most importantly, being able to react to customer needs much faster by the ability to scale quickly. So clearly a win-win kind of situation. But then the question that comes up is if banks are going to hive off a chunk of the work that they do, what do banks do? And the reality is that banks need to rethink their role, and in doing so realize that challenger banks like Google, Amazon, large platforms are moving into their space. Completely unbeknownst to or by stealth, Google Pay, Amazon Pay are becoming realities, and they're becoming large payment banks. The second thing that banks need to look at is each client as a special segment. And you can do that with the emerging technologies, data analytics, artificial intelligence, etc. But more so, a change in thinking. Making the client at the center of everything. All of us use products like soaps, toothpastes, etc. But however big the consumer goods company that makes them, the first thing they do before they launch a product is they have customer focus groups. They bring customers together, let them try the product, the concept, and get their feedback before launching a product. Banking never worked that way. And it is just about starting to move to client centricity. So focusing on those aspects because they own the clients and they know the clients. The third thing is that the role of banks is changing, because today the competition is not so much from what technology you have, what products you have, but it is about relationship management. So banks should think about how well they manage their relationships with their customers, become their trusted advisors, deal makers, and completely rethink how they operate. The other interesting thing that is happening is that with the collaboration of fintech and banks, ecosystems are being created. I call it the dawn of the ecosystem age, where different aspects of the bank's work are handled within an ecosystem which may comprise one fintech or many fintechs. And then the next stage is that fee-based banking is becoming a reality. More and more customers are happy to receive fee-based services based on their needs only, and almost a menu-based product offering, especially in the commercial relationships. And the creativity will come in going beyond banking, looking at non-core activities like maybe corporate treasury, risk management, advisory services, infrastructure project finance, offering these services to their clients. I'd say even going far as integrating healthcare, insurance, etc., into their offerings. And lastly, providing leadership in financial inclusion, environmental, social, and governance processes. So banks need to think about how they reshape and reinvent themselves. And in the words of a famous man, banking is necessary. Banks are not. With that, I end my session. Thank you very much.